buy the dip, and you're going to regret buying the dip. Well, I think sharp is useless.
Let me extend that conversation to this whole idea of active versus passive.
I take it with a grain of salt. Trading is nothing more than solving your own financial problems. And my financial problems are different than other people's. Stay in the now, don't predict, and understand yourself.
Tom, thank you so much for taking time to talk to us. You've been one of the most quietly influential voices in the trading world, someone whose calm, disciplined approach has inspired generations of systematic traders. For those of you who may not know Tom, he is called Mr. Serenity, a name Jack Schwager gave him in the book The New Market Wizards. He began his career as a chemical engineer, but what really set him apart was how he brought in an engineer's precision and process thinking into trading. In the early 1980s, he founded TrendStat Capital Management, one of the pioneering systematic trend-following firms in the US, managing nearly $600 million at its peak. TrendStat was about building systems that could think, act, and manage risk without emotions. Tom designed processes that turned market data into orders, a true engineer's version of trading. He was among the first to emphasize position sizing, volatility control, and diversification long before those ideas became mainstream in portfolio management. But perhaps more than his technical mastery, it's his philosophy that continues to resonate with many. Tom believes the real edge in trading comes not from indicators or predictions, but from mastering oneself, our emotions, our processes, and our patience. His motto, "Enjoy the ride," perfectly sums it up. Markets rise and fall, systems win and lose. The goal is to stay balanced and keep learning. Even after retiring from TrendStat in 2003, Tom continues to trade and mentor design systems that can be managed in under an hour a day because he believes good trading should give you more life, not take it away. Tom, it's a real honor to have you with us today. You influence many of us think about systems, risk, and the art of staying calm in chaos. Let me start with something simple. When people call you Mr. Serenity, what does that mean to you? And has that calmness always come to you naturally, or did trading teach it to you?
I learned over a period of time. Originally, I was a 22-year-old out of college, drank way too much coffee, was trying to do too many things at the same time. I was very distracted, high energy, trying to just get everything done that I could possibly get done. I went at a pace back in my 20s that I could not keep up with today at 73. Little by little, I started increasing what I would call self-awareness. And it could be as simple as being on a Zoom call or, in this case, Riverside we're using today for this platform. If I were to look at the screen and look at myself talking, I can say, "Tom, you should smile more," or "Tom, you should be serious." And I can change the way it looks, and I can feel the muscles in my face doing different things. And so I know just by thinking about it now what my face looks like without having to look at me talking on the screen. So that's a bit of self-awareness, and that's just a small, very small example of that. But it could be everything from I started recognizing tension in my fingers while I was programming. That meant I was a little bit more stressed. So I just go like, move my fingers, loosen them up, and I'd feel more relaxed. And so those were all just observations of what's going on with your body, what are you thinking, and all that. Well, in trading, as I went forward in my 20s and got into the 30s even, which was before I met Jack, you really I ended up becoming decaffeinated. I ended up continuing to try my best to figure out how I could sort of read my own mind on what mental state was I in? Was I getting excited? Was I getting greedy? Was I getting fearful? Was I getting angry? Was I all these different emotional states that people go through? And I started realizing that I could choose to be balanced and calm and think strategically a lot more than I was doing. So I started taking on that, and it got easier and easier as I kept working at it. And eventually, I think I've told this story before, I decided every half an hour, I put a little, what do they call a post-it note, the little sticky note thing. I stuck
Yes.
it on my screen. And every time, I actually would see that, and it would say, be aware. And what that was a reminder to me of just to go through a little bit of a analysis of myself, and was I aware of everything that I was doing at that point? And it kept reminding me over and over again. So now, like every 30 minutes, I'm doing this. Pretty soon, after a few weeks of doing that, you find yourself doing it continually because you don't want the half an hour to come up, and then you have to ask the question, were you aware? And answer, no, I wasn't aware. And then you have to kind of kick yourself because I was supposed to be aware. And so little by little, it got easier and easier. And now it's just real time. I pretty much am aware in the middle of a
It's
golf
second nature
swing.
now.
Yeah, it is. I've been doing it for 50 years or something. I don't know. But it's a learned skill.
Got it, got it. So I've got to learn that too, because with these days, I'm sure the number of distractions that we have are way too many. Even when
Yeah.
we are working on a computer, we have way too many tabs open, and I have that bad habit of opening many tabs at a given time. So I think I need that sticky note more than you do today. So
Yeah, you finish a tab and you get rid of it. I've got a total of, well, see, two of the tabs are for you guys, and I have three other tabs open.
yeah, got to learn that. So one of my questions, which I did research a bit about you, but I didn't find much about what kind of a student were you in school a little before you got into college, and what was your sense of the markets at that point of time, or were you had, it's quite possible that you had no sense of the markets at that point of time. But I'm just curious, what were you as a high school student?
A high school student, I was third in my class of 103. Got a lot of scholarships. I probably had more scholarships than everybody else in the class. So that worked out pretty well to help me get through college in chemical engineering because I went to Clarkson University, which is a private university, and it cost a lot more than my parents could afford. So the scholarships really helped.
Was chemical
Uh,
engineering out of choice, or was that the in thing at that point of time?
I loved chemistry. Still think it's fascinating. I liked organic chemistry the best, even, but I just liked the sort of the application. Math by itself to me was a bit of a dry, kind of interesting topic, and I was decent at it. I wouldn't say I'm a brilliant mathematician or anything, but I understand math pretty well, but I understand it from the practical nature of what could you apply this to. So, for example, when you take integral calculus, it's a very esoteric thing, and a lot of people are bewildered by it. But I immediately, when they started describing integral calculus, saw this lake, and I was trying to map the bottom of the lake, and it's going all over the place. So you're breaking the lake down into tiny squares and integrating them together to get the volume of the lake, an approximation. But that's kind of taking sort of a dry subject like math and applying it to the real world. And I did the same thing in various maths and in chemical engineering, the thermodynamics, fluid dynamics, all these different aspects of chemical engineering have a lot of math, but it is actually trying to do something with the math in the real world to help people or to produce a product or to whatever, and so it always fascinated me, and I loved chemistry. So chemical engineering is the combination of math and chemistry.
Lovely.
Made
So,
my decision.
and from Clarkson, you joined Monsanto straight away.
Yes, right out of school.
And and what were you doing at Monsanto?
We were doing industrial chemicals. I was helping to design new plants and debottleneck older plants that we needed more capacity out of, or we needed to, back in those days, we were through the oil embargo days. So every bit of energy that we used in producing anything needed to be very, very efficient. So any way of capturing escaping heat and using it to preheat a feed stream or anything was fair game. So we're always looking for ways of squeezing down the efficiency, squeezing up the efficiency of the process to either produce higher quality product, more product, or reduce the energy usage.
And when did markets happen during this phase? Was it in college or was it after you joined?
High school is when I started buying my first mutual fund. But at that point, I was not at all cognizant of market movement. I wasn't tracking anything. I wasn't charting anything. I was simply taking the monies that were coming in as I worked on a part-time basis, either the paperboy from 12 to 16. I bought mutual funds, and then when I was 16 to 18 and graduating out of high school and going to college, I worked in a grocery store. So I bagged groceries and stocked shelves and brought carts in from the parking lot and that type of thing. Every now and again, I would run to the bakery to pick up a batch of Italian bread for us to sell using the owner's car. He trusted me to drive his Cadillac. So a lot of good experiences as a child before I got out of high school, and all this extra money just kind of kept going into my mutual fund account, and it built up more and more.
Did someone tell you about I mean, I'm
Yeah.
I'm curious, a 16-year-old boy investing in a mutual fund, how did you figure that out?
Oh, it was
Hmm.
as I was 12 years old when I started
All
investing.
right. Okay.
And how that happened was my father, who was a postal delivery guy, he would walk around routes and deliver people's mail. He for some reason, I'm not sure why, had a mutual fund salesman from Fidelity back in those days come to the house, and he listened to the sales pitch, and I listened to the sales pitch. I ended up buying into the concept and decided I'd put a little bit of my $10 a week into this mutual fund. And it kept building up, and I started seeing that it got more and more. First, it was $100, and then it got to be $500, and it got a couple $1,000s, it really didn't dawn on me that much that the prices went up and down as much as they did until I got out of college. When I was graduating as a chemical engineer, all of a sudden I looked at it and said, I put this much in and it's worth that same amount because of all the ups and downs. And I went back and tracked it and I started realizing that. And I then really got into charting and trying to sold out of the mutual fund and started managing my own money and used that as part of the seed capital to start my own account.
Hmm. Interesting. And at that time, what did charting mean? Because we did not have these electronic tools, I'm assuming.
Yeah, that's for sure. I wore my eyes out and my poor fingers from holding onto a pencil and charting. I would have chart paper. Everything would be done with a ruler and a little bit of a stroke of the pencil. And maybe once a week or so, you'd put a date down at the bottom so you keep track of where you are. Things like point and figure charting compress lots of history onto a smaller page. So a lot of the people today trading probably may have never even heard of point and figure charts, but when we started out, that was a pretty widely popular way of charting because you could compress the price data into uh, a smaller amount of space. And to this day, I use a concept of combining together bar charts with point and figure, and I call it point and figure bar. I just combine the two concepts together. It's just something that works in my brain. It's not important. It's not magical. It's not the magic bullet or anything. It's going to have the same types of statistics as a Keltner band or a Bollinger band or Donchian channels and lots of other things. It was just a slightly different wrinkle to it. But when I got started doing that, I started realizing I looked down at a bunch of charts. I actually was starting up my commodities trading at that point. I was very successful in stock trading, and I put a bunch of charts down on the floor, and I was up on the sofa looking down at the floor at all these charts, and I could say, "Wow, that move in live cattle was crazy. That move over here in gold was nuts. You could pick that up and make a lot of money." And I started realizing what were the common threads between these, and I was viewing it from a point and figure, view. And when I decided, okay, if I just get on every breakout, I don't care what it looks like, I'm just going to jump in on it and ignore the news, ignore the analysts. I'm going to pick up every one of those, and they're going to pay so much money that I can make losses on all the other false breakouts, and it'll work. And so I set out to do that. And that probably was a few years, year to 2 years into the process. And another,
When was this? Which year would?
this would have been back in the 70s, probably of around 76 to 80, right in there someplace. And it took 4 years, but on the fourth year, I actually got to where I was finally slightly profitable. And at that point, it just got better and better.
Hmm. And since we're talking about markets, did you read some books? Were there people whose ideas influenced you right in the beginning in those 4 years?
Yeah, the Mark Douglas books on the psychology of trading. I can't even remember the name of them now, but
Trading
he's
in the Zone?
yeah, Trading in the Zone is definitely one of them, and there's a couple of others he wrote. All of them are really good. I do like now. I don't know if it was done then. I think it was probably more in the '80s, but Trade Your Way to Financial Freedom is a great book by Tharp. He covers the three general areas that I think are important for traders to understand that they have to deal with. One is, how do you buy and sell? That's the whole area. I call it the buy sell engine. You got an engine moves the car. The buy sell engine's got to move the trader and make them buy or sell. But you got to know how much to buy and sell. So that's the second part. You got to size your positions. You have to maintain your positions. I would argue throughout the time that you own it, it's not just initially sizing the positions, it's also looking ongoing at what kind of position do you have. If you bought NVIDIA at 10 and it's now whatever with all the price movement it's had over the last few years, well, if you haven't adjusted that position, then you have a NVIDIA portfolio with a couple little decimal points of other things in there. And that's not a balanced portfolio. So you have to come to grips with how do you manage your ongoing. And then the third area he covers, and I would say Tharp is an expert in it, or was an expert. He's no longer with us either. Is the area of psychology. The mental processes in trading are so potentially overwhelming that a lot of traders get caught up in all sorts of mind traps that you really have to try to understand yourself very well. I think trading is the one thing in my life that's taught me so much about myself. Very fascinating education, I would say. And all three of those areas have to be in place to be a successful trader, I think.
Right. So, talking about trend following, was there um, a natural inclination that you had towards trend following, or did you explore during these 4 years different kinds of trading across different time frames, and then figured out that trend following works better for you? So, how did the evolution of trend following in your mind, how did that happen?
I would say at first I was a little bit more trying to be a fundamental guy, trying to understand the supply and demand of a market or the fundamentals of a company if I was buying shares. And the process was I didn't have a lot of time. The process was very time consuming. So I felt like I really couldn't spend the time I wanted to spend on doing some of this stuff. And I realized that in the end, the guys on Wall Street have staffs of people and computers that I don't have, mainframes back in those days. PC hadn't even been invented yet. And so it really became sort of what can I do to pick up on the move that is going to happen if I look at all these different things across the board. Uh, this one might be the next one that goes. That one over there might be the next big one. And I don't know how I'm going to predict which one. So if I can just look at those price movements and the big guys are pushing it and breaking it out through an indicator of some sort, and if I could jump on quickly, then and do it in a disciplined fashion, I should be able to capture a lot of that move. And so I didn't even know at the time, there wasn't a term called trend following back then. It was just to me jumping on the so many moves that looking for some to come out in my favor. And lo and behold, maybe 10 years after that, people started calling it trend following, I guess. But it was, to me, it was just trying to jump on moves. And it was a sort of playing a statistical game of these 30% of the moves are going to be very profitable. The 70% or 66% or so are going to be losers. And I'm going to try to, minimize them as much as possible. And out of the 33% or so that are profitable, perhaps a few percent, like less than 5, will be humongously, way, 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 way profitable. And those are the ones where you're in for a year, year and a half, and it's up hundreds of percent. That pays for an awful lot of losses. And I think that's what I locked onto early on, and just kept running it for what, 45, 50 years now.
Got it. So you said you would, you started off being a fundamental person, but then when we talk about commodities, there's no fundamentals there. It's largely demand and
Well,
supply. So
yeah,
so was there
there
a different
is
thing? Yeah, there is.
there are some fundamentals, but
Hmm.
yeah,
Okay.
yep.
So how did you get started with commodities? What was the idea behind getting into commodities?
It was diversification. When I started out, the world was, the Indian market was a lot younger. Japanese market was out there. There was some stock markets in Europe. And the correlation amongst the various indexes around the world were running maybe in the point sixes, high point sixes and stuff like that. I mean, it was there was a decent amount of diversification. So you could put a portfolio together and you could do some US stocks and some Japanese stocks and maybe some London stocks and get a little bit of diversification. As computers came in 1980, the PCs really started taking over the world. The AT a couple of years later, everything just blew sky high. What ended up happening, I observed the indices around the world started becoming more intercorrelated. People were able to just transmit an order to Japan real easily. It didn't involve calling a broker and people sending teletypes and all of the nonsense. So if New York was up that day, Tokyo tended to be up that way that evening. For us, morning for you over in the Far East, and then you'd get London and Germany and France all kind of up, and then you'd go back to New York and start over again for another 24 hours. And now you look at the world and you're up into the almost like high point eights on the correlation, maybe point 0.9. It's become very, very correlated. So for me, I was just looking for a way, if the stock market were to go through a 50 cent on a dollar down, 50% decline, I didn't want to be just totally oriented towards stocks. I was asking myself, what could I trade that, you know, might go up during that period or might I'd be able to make a profit. And so things like gold were interesting. Silver had a big run when the Hunts tried to corner it way back when. There was lots of big moves that happened in commodities.
Just the way it's
If,
happening right now.
yeah, well, frosts in Florida for orange juice, coffee having a problem with a frost in Brazil, and the crop is looking to be small, and there are lots of different things that are going on. And when you sit back, just not as a statistician, just as a human being, a logical thinking person, and you ask yourself, what does coffee care about what the S&P 500 is doing? Nothing. They are diversified. They're two different, completely different markets. One could go up and the other one goes up. One could go up, the other one goes down. The two have nothing to do with each other. And you could say the same about, let's say, live cattle and the euro. What those aren't going to have a heck of a lot of. So if you're trading live cattle and you're trading euros, you got a diversified portfolio. So it led me to put together more diversified futures portfolios because there's just a lot more opportunity to get away from just stocks. I still trade lots of equity indexes, so I have exposure to stocks. That's one of the many things I trade. But I have lots of other things and grains and meats and metals and industrial metals and currencies and debt instruments and energy. And, you can get pretty widely diversified very quickly in the futures markets where it's hard to do that in stocks anymore.
Got it. So during this phase, when now you have a sense of the markets, you're doing commodities, you already done equity, and now we have computers. At what point did you realize that looking at the markets through the lens of a rule set or being systematic about the markets is the way to go? So at what point did you, build that conviction?
Usually at the School of Hard Knocks, what we call the Trading University, I would catch myself doing something that was not part of my strategy, either through just a simple human mistake or some kind of um, a mental flaw at the time, an impulsive decision or something. And I say, wait a second, Tom, that's not what you're supposed to be doing. And so I kept thinking to myself, how can I sort of take myself as a human being full of the ability to make mistakes and have emotional decisions and all that? How can I reduce the uh, the impact of me? And I started realizing as I started just making my day more efficient, like it could be something as simple as you're trading along and you do trade after trade, and you're always doing 1,000 shares of this next stock that you're doing. And so you just get on autopilot and you start doing 1,000 and 1,000 and 1,000, and you just keep going. And you're not thinking too much about, but one's a $10 stock, the other one's a $20 stock. So you just, on the $20 stock, you just bought twice as much. Or maybe you buy 500, you always buy just, the same dollar amount. Well, that's treating them all the same in terms of dollars, but one might move twice the speed of the other. So you just got twice the impact to your portfolio from the volatile one versus the quieter stock. So I started realizing that if I could just put the parameters of the trade into a little spreadsheet, it could spit back to me the exact number of shares that I should do to keep the portfolio completely balanced and every position equal. And as you start realizing that little bit of automation all of a sudden saves you pounding a calculator, potentially hitting the wrong button and making a mistake, it automates it a little bit and it starts opening this world of automation to you and saying, wow, I could bring in my prices instead of looking at the screen and writing it down on a piece of paper. I could pay a little money and go to this database and download it. And then once I download it, I have it so I can get rid of this piece of paper stuff. And once I have the prices here, I could actually run this instead of me looking at a chart and deciding that's where I'm supposed to buy. I could tell the computer how to do that, and I get rid of that part of my job. And I was just basically trying to put myself out of work. And little by little, then you squeeze the error rate down. You're doing the same thing you were supposed to be doing in the first place, but you're doing it by hitting a button on a computer, and the computer's doing all the drudgery, the manual, calculating the same thing over and over again to the point of boredom. And that allows me to think more globally, invent new ways to trade, invent new programs to keep track of things or to do research studies. That's more creative human endeavor and a lot more fun. The actual running of the orders every day is the least exciting thing I do every day.
I get that. So going back to your spreadsheet days, were you back testing on spreadsheets at that point of time, or how did this whole idea of be it rules or be it back testing, how was it done at that point of time?
Wall Street Journal in a pile, pull a price, put it down on a sheet of paper, put the Wall Street over here, get the next one, open it up, write down the price. Get that all done. Take several years of doing that. Your hands are now black from ink off the paper. And then what you do is you take all these sheets of ledger paper that you've written down all these prices, and you start translating them into chart paper. So you take a ruler and you move it over one little square and you draw a new line and a new line, and a new line, and you make all that happen. And then you assess using whatever the indicator, like point and figure or whatever you were doing. You would then try to do a trading summary by writing down the date of a buy, a date of a sell, how much did you make or lose, and then you'd eventually have that study complete. It might take weekends over and over, like 2 or 3 weekends of very hard work, tired eyes, to get a study done and realize that, this makes some sense to me. It just makes logical sense. I'm going to go ahead and start trading this way. There were no computers. I did this primarily in the 70s. So 74, I came out of university. About 1980, I got my first PC. And that's when I started automating more in the computer. And then things happened fast after that.
Did you get prizes? Was there databases on through which you could get prizes into a spreadsheet?
Yeah, back then in 1980, I was able to tie into some of the, I would call them crude databases for a little bit of money. Um, it got better and better, and it has continually gotten better. Now there's multiple places you can try to get data from, and some of it for free, some of it for a modest amount. Um, but the historical data now is so much superior to where it was back when 1980 rolled around and people were clamoring for data so they could put it on their computers, but the database companies hadn't been keeping track of it. So then they were scrambling to try to figure out, well, how can we get 10 years of history so these people can buy it from us?
Buy it from us. Yeah.
But they hadn't been keeping it. So they had people were scrambling to try to figure out. It was the wild, wild west.
I get a sense of what it was.
And
But
also
then,
the data had flaws. You had to run
I'm sure.
data checks. I would run a check like, here's the high or low for the day, and the high and low, and the open was here, up above the high.
How can
The
that
high
be
and
possible?
low, it can't, or the close. The close is below the low. Can't happen. So you'd spit it out and you'd have to go back and try to make sense of what was going on and what would be a logical answer to the data and correct the data and go back to the database company and say, you got some screwy data in here. You might want to check that again. So it was data integrity was a real problem. And the PCs back then were, this is like Windows 1, not Windows 11, many, many operating systems ago. And it was pretty rudimentary. There wasn't a lot you could do with it, but it was better than a calculator. And then the AT was, I don't know, I want to say 3 to 4 times as fast and capable. So I bought the AT right when it came out and loved that. And that really pushed us forward quite a bit. And then after that, I just kept adding more and more PCs, and we ended up with a lot of Dells and some computers that didn't even have screens. We'd set them up so we could do a switch from one screen to like 4 different computers and just switch to whichever one we wanted so that we didn't have to buy a bunch of monitors and consume the electricity and all that. So we were running server banks before they were server banks, I guess.
There
We
were server
were
banks.
stacked them up. We had a good air conditioning in our little office at TrendStat.
So So if I go back to those days, was there a trading system that you were running? I'm sure there was. And what was that? Can you give me the you know, in a rudimentary sense, what exactly was that
Yeah,
first trading system that you had?
in a
And on what
rudimentary
time frame
sense,
were you trading?
in a rudimentary sense, I was using point and figure philosophy on bar charts. So,
Okay.
for example, X's go up on point and figure, O's go down.
Yes.
So I would let the bar, the bar chart would run up. That's a row of X's. It would peak out and go the other way. So that would be the kind of the top of the X run, sort of like what people call swing trading, where the swing highs and lows, if you're trying to trade the range, would also be conversely the breakouts if you were trying to trend follow it. So if you try to stay inside those peaks and valleys, that's kind of what sideways trading or swing trading. If you break the swing highs and lows, that would be more like breakouts. So that's kind of what we were doing. Pretty long-term trend following, not a specific time frame. We let the charts tell us where that was and just go with it. But we could always measure the risk on the trade, the volatility on the trade, properly size our positions, cover lots and lots of markets, which a lot of traders, because of they were doing it human driven. As a human being, you're limited to how much you can handle. You just
Yes.
can't process,
A
a
lot.
lot of stuff. Computers, 200 markets is no problem.
Can we call it? It was something on a daily time frame, or would you want to call it a weekly time frame? Because you were, I know you were on point and figure, so the aspect of time may not be relevant. It's more price than time there. So, but how did you? At what point would you go back? What was the interval at which you would go back and check prices?
It would be daily. And remember that we're using point and figure bar. The bar is daily. We're using point and figure concepts over top of the bar. So that's why I call it PF bar.
Got it.
So it's a kind of a blend between the two. But we'd update daily, get new prices, new orders, cancel and replace the entire set of orders. So a lot of orders were going in. We had like a few hundred clients and $600 million and 40 computers and 10 people and a lot of stuff happening.
Hmm. Interesting. So, so if you now that you've seen 1980s and how trend following was then, and then 90s, 2000, all the way till today. A lot of times when I speak with people who do trend following, they observe something called an edge decay, which means the same strategy when run over a given instrument, the returns kind of reduce over a period of time. Did you observe something like that, or do you observe that phenomena?
I don't observe it as much as a lot of people seem to think there is, but I do observe that those trends happen quicker. My theory of the whole world, as I've observed it over the last 50 years, is that computers have reduced the time for everything to happen. So we go back to when I would do my first futures trade and I called a broker and want to buy 2 corn, and he's got to write it up on a piece of paper and he's got to run it down to the teletype operator. Teletype goes to the floor gives it to a runner, the runner runs it out to the pit, hands it to the guy, he does the hand signals, they get the execution, he writes down who he sold it or bought it from, drops it down on the floor, the runner climbs under the pit, gets the piece of paper, takes it back, and about a half an
Mm.
hour later, if I'm lucky, the broker gets something in his inbox, calls me and says, "You got your fill." Nowadays, I'm on one screen over here with my trading platform. If I were to do a market order on 2 corn, by the time I hit the transmit button and turned my head to there, the bottom of my right screen over here would be a little message saying, "You just executed 2 corn." That's how fast everything is. And I'm in Arizona, nowhere near the Chicago pits or anything. So the world's a different place. And because of that ability to move larger contracts through a very small amounts of time,
Mm.
every movement of the market can be accelerated far greater than it could ever be back in the 1970s, because in the 70s, you just had a lot of impediments to getting things done. You had to work hard
Got it.
to move the money. Nowadays, you can do it on your phone. It's ridiculous. So from anywhere in the world, you guys in India can trade around the world. I can trade India. It's getting to be a very small world out there. And I think because of that, bear market that back in 73, 74 in S&P down 50% in those 2 years. Now you can do, say, down 35 during COVID in about a month and a half, and it has the same horrifying, scares the living daylights out of everybody. Um, so it has the same psychological effect of being a bear market, but it's compressed down into, instead of 2 years, it's only 35%, but it happens so quickly, it scares the wits out of everybody. And then it turns around and makes new highs. Just one more bear market. I've lived through a lot of them over the years, but my thesis is that all of this stuff's happening with much, much greater volatility. So you need to think through how you deal with greater volatility and size your positions properly and be careful.
I get that. So, so in a sense, what you're saying is, since things are happening faster, does it mean we have shorter trends? And how does it change the structure of the market in terms of pullbacks, in terms of how the way the trend would manifest in a given product or an instrument?
I think there's the potential through speed of motion to have more psychological impact in a smaller amount of time. So my thesis is that yes, the time that the trends persist could be a bit shorter, but then you get situations like we're in now in the U.S. where the stock market just keeps kind of making new highs and making new highs, and every pullback becomes a buying opportunity for some who want to buy the dip. And I hear that on the morning news all the time. You got to buy the dip, buy the dip, buy the dip. I mean, at some point, you're going to buy the dip and it's going to keep going down and you're going to regret buying the dip. But right now, that's working great. I think you still have to have the psychological euphoria of a good market and you need to have the psychological horror of a bear market. And I think those are able to happen a lot quicker than they used to.
I want to get to something more specific when I ask that question. So let's say you follow a breakout system, or you follow a moving average kind of system to identify trends. Does that mean the kind of parameters which worked 20 years back or 30 years back are not the parameters which would work today, and you would have to kind of reset the parameters for today's volatility, for today's trends? Can you help me structure that thought?
The answer to me is make your indicators include things like volatility so that as volatility gets greater, your indicators adjust themselves. So if you examine the math behind math is dry, but if you can make math practical, I like it. So if you look at the math behind, say, a simple Donchian channel, which I use a lot because it's simple to describe it, it's the high of, say, the last 21 days and the low of the last 21 days.
Yeah.
Well,
Yep.
if you use 21 days, and that's about a month of trading, including holidays and whatever. So you got this kind of top and bottom band of the Donchians, and the highest high and the lowest low. Well, if volatility gets greater, guess what happened to the
It
Donchian
adjusts.
channels? It
Yeah.
got wider. So it
Yes.
adjusts itself over time. And I like indicators like that. I don't like things like, say, a hardwired 50-day moving average, or a 21-day moving average. That is a very specific time parameter, and everything that happens within 21 days is going to be into the average. And then the daily prices or whatever other indicator you might use to go across the 21 days is becoming more volatile, and you're not adjusting at all for that. That's worrisome. But things like Keltner adjust, things like Bollinger adjust, my point and
Super
figure
trend.
bar adjusts, my Donchians adjusts. All of those have that same volatility inherent. adjustment to their indicator math that takes into account changing conditions, which I think is over time a lot more robust, it seems to me.
Makes sense. Did you ever use moving averages, and what's your thought on that?
I did use moving averages very, very early on. And my thought on that was when I went back and tried to do an optimization of the moving averages to figure out what would be the optimum, it would always change. And so I thought, well, how can I do something with this that changes automatically? Because this is not working. And that's when I saw Keltner could use the average true range on the top and bottom of a moving average and therefore expand or contract with changing volatility. And I thought, that's the way to go. Use it as the basis and then top and bottom do the average true range bands on either side of it. And that gives you that flexibility with changing market conditions. And I abandoned rigid moving averages from that point
2150
on.
kind of stuff. Got it.
So,
So moving to, I was listening to one of your interviews, and you speak about a concept called filling the potholes, where among the other trend following strategies, you kind of also have some mean reversion strategies. So could you help me understand what kind of strategies are those, and what are we trying to do in those strategies?
okay, I don't do mean reversion myself. It is a good alternative to use to fill potholes. Lawrence Bensdorp, whose book is
Yeah,
like
yeah.
right there, um, as a friend, and he does a lot of multiple trading strategy research, and I think he trades like 56 trading strategies simultaneously. I credit him with the term "fill the pothole." It's not my term, but I like it. It gives me the image of the track record going up the page and then a
Yes.
drawdown happening, and that's the
Hmm.
pothole, and I want to
That's the
fill it.
pothole. Yeah.
And yeah, drawdowns are not fun for anybody. If you look at a lot of those potholes with trend following, you realize that mean reversion strategies many times can help fill that pothole. Lawrence does it a number of different ways. The way I deal with the same situation is, for example, let's say I take a 21-day Donchian strategy, and I've got the typical long-term trend following drawdown that you're going to see in any kind of trend following strategy. Then what I'm going to do is pair that same markets, same portfolio. I'm going to pair it with maybe a 3-day indicator, 3-day Donchian or something. So if you think about what happens, let's say you have a big run in gold and it's right at the high of all time. You're making tons of money on your long-term strategy. But your short-term strategy on a 3-day basis is ready to go short. So the market comes off that peak and immediately your short-term strategy goes short. So you got one up, you got the other one down,
Other down.
and
It
you
kind of
just
cancels each other.
kind of cancel each other, and you've taken the risk way down. You've improved your return to risk ratios, which is I'm a big fan of. If you are a return guy, I'll freely say if you're trying to make your first billion by the time you're 30, this is not the way to go. You want to have the wild ride and make as much money as possible. So if you're shooting for returns and that's your only goal, ignore what I'm saying. But if you're like me, retired, 73 years old, I just want smooth. You want a good return to risk ratio. What by doing that, what you're doing is eliminating the first part of a drawdown in the trend following strategy because you're at zero position. Then if it continues down, your long-term strategy is going to kick in, and
Also,
now
yep.
you're full bore, two strategies short, making a bunch of money. What I find when I do that, you do use the long-term and short-term, marrying them together helps the return to risk ratio a great deal.
Interesting. So some people call it multi-time frame.
Hmm.
Uh,
Yeah,
so that's what it is.
and I
So
do it across 30 plus markets. So
I'm just curious, how do you track all your positions today? So I'm sure it's easier than what you did at that time.
yeah, I don't do it by hand anymore. You can pull in your positions, you can pull in your um, the various the markets, and have a computer actually go through and say,
go
do
through it
all
for
these
you.
positions that the broker says that I have, are they really what I have? Tell you the exceptions. Say, hey, you better check the copper market looks weird here. You're supposed to have two short, and you only have one short. So then you go in and investigate and try to figure out what happened.
Moving to Tom, moving to position sizing, I was listening to some of your interviews, and you had some thoughts in terms of how you position size based on volatility. I had a follow up question on that. What I want to know is if this idea of position sizing evolved over time, and what were those triggers based on which you changed your thinking about position sizing?
My position sizing at first was highly affected by reading the first Market Wizards book by Schwager on Larry Height of Mint. Mint was one of our largest CTAs back in the day when I first started, Commodity Trading Advisor. They were handling about $1 billion, and that was back in $1980, so that was
My
worth a lot of
goodness.
money. And Larry was not, I would call a rocket scientist. He was more of a street smart guy. And it just made sense to him that you got to make the bet size the same on every bet that you make. So he was into the sort of the gambler's philosophy of approaching the markets, the statistics of making your bet size equivalent each time. And that's what they were doing. And when I heard him say the term bet size in the interview, he was referring to the amount of money you could lose. So therefore, mathematically, that would be where you're getting in versus where your stop loss is. So once I knew that he was making that the same each time, I thought, all right, well, if it's the same, it's got to be a percent of the equity somehow. So I started doing risk as a percent of equity, and that worked beautifully. And it improved my return to risk when I did the studies. So I said, okay, we'll make that definitely part of the programs. But then I started along the way, we had a silver trade that we got into, and the volatility was just unbelievable. When the trade started out, it wasn't, but when the trade kept going, it was getting very, very volatile. And I was experimenting with things with average true range at the time. And I thought to myself, well, if this is volatility, the speed of movement is psychologically affecting our clients because when markets move a lot, they're calling up and wanting to know what we're doing and all that. They're getting nervous. So it isn't just the risk of losing money, it's also the speed at which an investment moves that becomes a sort of risk factor in people's brains. So I need to think about controlling the volatility. So then I started saying, well, what if we did risk calculation and a volatility calculation both as a percent of equity, then take the smaller of the two, whatever the answer is. This one we go buy 10 contracts, this one says to buy 8, we buy 8, whatever the lowest number calculated. And then we added to that margin because there's some markets like euro dollars and other things some markets that have a lot higher margin for the amount of movement. So the risk is low, the volatility is low, but every now and again you get these big jumps. And the margin people know that you get those big jumps, so they protect themselves in the exchanges by putting a higher margin on it. So we did margin to equity as well. Once we had all three in place, we never had a situation where we were all that embarrassed because we had positions sized every day, across the portfolios, we were at the peak, we were trading like 75 markets or something. It was easy to do with the computers, and we could spread that risk a great deal. And I think that's where we brought the volatility into the calculation, I think was really impactful at smoothing things out. And in particular, where volatility comes in later in a trade. You start out, markets are quiet, nobody cares. It breaks out. You got a small amount of risk. And so here's your buying in here, here's your stop loss point. The market takes off. Fundamentalists start trying to predict why it's going up. Trend followers are jumping on. People reading the news are jumping on. Everybody's getting excited. Now, all of a sudden, this has gone to now every day we're doing that. So as volatility increases throughout the maturity of a really successful trade and everybody gets excited, measuring the volatility as a percent of equity becomes important because that gives you the excuse to say, yeah, you're getting a little bit too much volatility in your portfolio due to this one position. So if I squeeze down the position size a little bit, I have less impact to the portfolio. And as it turns out, you're taking profits too, as a plus. But I don't look at it that way. I look at it as managing the volatility and the risk.
Got it. Got it. Lovely. So there's another thing which I, read and probably listened to in one of your podcasts, and you refer to the idea of law of large numbers. And, can you help me put that idea in perspective? In what context do you think it's helpful to traders, and how did you benefit from it?
The simple way of putting it to the mental side of the trader is any one trade is just one data point in your next 1,000 trades. I say that
Mm-hmm.
over and over again.
Mm-hmm.
That's the way I truly think of it. If you have an edge and you know that doing your simulations, you make $1.25 for every $1 you lose over a lot of period of time, you want to get to that 1,000 trades and net your $1.25 per trade. So any one trade would be just a single, could potentially be aberrant piece of data that may go your way, may not go your way, but it's not all that important. It's the important thing is to get to 1,000. So just keep on doing what you're doing, keep putting another trade on, keep collecting more and more data, and allow that expectancy to come to real life. That's the way I would describe it generically and simply so that people could understand.
I get that, but I have another point there. So
Mhm.
let's say you have multiple trading strategies, and there's one strategy which kind of is more active than the other. So
Okay.
one would give you more opportunities, the other one would give you lesser. So if you were to kind of uh, look at it from a law of large numbers, there's one strategy which gives you more opportunities, but it also means there's more cost to trading, right? I mean,
Yes.
if we kind of uh, so how do you put that aspect into this? How do you build that in when we talk
Well,
about?
we actually at TrendStat, we kept track of every trade and exactly what the costs were to that trade. So there's the cost of the bid-ask spread. There's the cost, and that really reflects in the like if you put your stop at 4,000.50 and you got filled at 4,000.60, the slippage was 0.10, 0.10. Uh, there's also the slippage due to the commissions. So maybe you're charged X dollars in commissions due to the trade. So that's commission slippage. There's also, if you're doing Forex, there's also the time slippage because you're doing forward. So we call it forward slippage because you're probably doing it spot, or at least the broker that you're working with or bank you're working with is doing the spot price, and then they're forward pricing it out to the end of the month or wherever, and they'll add on a slippage there. So we would track all three of those. And then when we did simulations of history, we would use those actual numbers on each market. So if you're trading something like red rice in Tokyo, you're going to have a really big slippage number in there. And when you do the simulation, you're going to realize you're going to lose money all the time. It seems. If you trade something like US Treasury bonds, you're not going to get a whole lot of slippage. It's going to be very minimal because the market is so deep. And so that's kind of the way we take care of it. On the simulations, we actually try to put some money
Got
in
it.
there for those markets.
So today, when you look at a back test or a strategy, Are there some key metrics that you focus on? Let's say if I have to ask you about your top 4 or 5 metrics, you look at them and say, that's your first, view of that strategy. What would that be?
I would say the first thing I look at is the maximum drawdown. And then I would say I would probably look at a simple, very crude, what was the average return to the maximum drawdown, which is like the MAR ratio, MAR ratio. Then another metric that I like that I invented myself is called the enjoy the ride or ETR comfort ratio. And what that is an integration of all of the up days that you're at new highs or not in a severe drawdown, let's say, where you're plodding along and clients would be happy and you as a trader would be just comfortable with it. That's the comfort area. And then the discomfort area is when you go beyond a certain threshold of a drawdown, magnitude wise, and you go down a long enough time threshold where it's getting old. So it could be something like, oh, I'm good down to 10%, I don't care. Anything less than 6 months, I don't care. So you set some thresholds. Anything over that amount, you're in discomfort zone and you integrate those together every day. And by doing that and you put the comfort over the discomfort, you have a comfort ratio. And I like to look at that from the standpoint, the higher the better. And so I use that measurement sometimes too when I'm.
It's a ratio of time.
It's a ratio over the time period measured, particularly useful when comparing one strategy versus another strategy. How comfortable would you be as a trader running these two things side by side? And what happens when you combine them together, maybe? What happens to the comfort ratio when I take a long-term strategy and put it with a very short-term strategy? Where does the comfort ratio go? And what you'll find is if you use comfort ratio as a measure of return to risk, you'll very clearly see how you can improve your return to risk ratios and make you as a trader more serene. So you could be Mr. Serenity too.
Absolutely, we all aspire to be. So, so other than that, any other ratios? So we spoke about.
Well, I think sharp is
Okay.
useless. Um, I can't understand how the heck
Why?
somebody.
Okay.
Well, to me, it's useless because it's standard deviation. It's what it's saying is that uh, movement of price and returns is somehow bad. Well,
Bad. And that's
it
what we
is.
want, actually.
It is. Yeah, exactly.
Yeah.
And
Mm,
especially in
mm.
an up market, it penalizes a move up. Like if you were to make 100%, you're penalized on your Sharpe ratio because you made too much money too quickly and it runs the denominator up. So Sortino attempts to take care of that, but it's still using only volatility as a measurement, and it's negative volatility
Mm.
as a
On the
measurement
downside,
of
yes.
on the downside.
Yeah.
So it still doesn't quite capture it. So some of these types of, I guess, measurements that are on the normal packages out there, I, I they're there. I can glance at them, but I don't really think they're that useful.
Got
I
it.
prefer to my comfort ratio is a lot more getting at the heart of what you should be looking at as a trader, I think.
Makes sense. Makes sense. So that, Tom, that brings me to the next question. You've been a systematic trader, but then have there been moments where you said, I don't trust what the system tells me, but I need to take my own call? So have there been moments of discretion, and how did you deal with that? Is my next question.
After using discretion back in the 70s and miserably failing at it, I don't do that. During COVID, for instance, a lot of commodity trading advisors literally shut down their programs. They thought the world was coming to an end. The markets are insane. We are no longer trade until this settles down. I just kept trading and did the same exact thing I'm doing today. Ended up short a lot of stuff in the crash of COVID and ended up getting signals to go in long when the vaccine, the jabs were rolled out across the world, and we thought we were saved maybe. Markets went crazy. up, I ended up making 103% that year, doing nothing other than just following what I'm doing now. And believe me, I don't ever expect to see that kind of return again in my lifetime. Markets lined up perfectly with everything I was doing. It's just sheer aberrant, multiple standard deviation
Absolutely. Absolutely.
performance way, way beyond what I would expect. I would expect 15, 20% would be a good year for me. 103 is insane. But it points to just doing what you're doing and understanding enough about it to be comfortable in an environment that's scaring the heck out of everybody else.
Makes sense. In fact, my next question on my list was about COVID. I'm so glad you brought that up because but you answered my question.
Yeah.
And talking about discretion, there's something which I tell people around me. I have a kind of an inverse win rate with discretion. Every time I take a discretionary call, I am damn sure it's not going to work in my favor. So I usually tell my friends or people around me that I'm making a discretionary call and I'm going to be wrong, and I'm always wrong. So I've got to kind of invert my discretion. So that's been my that's how
But
it's been for me.
that can get very confusing after a couple of, like, I'm thinking this, so I should do the opposite of that. But boy,
Yeah.
that doesn't feel very comfortable.
No, I
Now
wouldn't do it. No,
that could
yeah.
also mess your head up pretty badly. So
Yes, yes,
I
yes.
would guard
So
against doing too much of that.
no, it's more in terms of how bad my discretion always is. So it never works. That's what I want to say. So
Yeah.
talking about COVID, yeah, I'm glad everything worked out and things went fine. But then had would have would it have been, or let's say, was it ever possible? I'm sure that you there was some kind of a tail risk which was not factored into your system, and did you have that fear? Did you think about it? And if you did, was there a way to deal with it other than diversifying across different assets?
Yeah, my position sizing kicked in big time. As the stuff was going down, my stops were not coming down as fast as they usually would because, well, think about it, a 21-day dungeon, for example. You go into the COVID crash. So the top and the bottom is here. Well, the COVID crash happens, so now
It's
this
all the
is
way down.
going all the way
Yeah.
down, but 21 days later, the highest high is still up here, hasn't moved.
Yes. Yes.
But now the Keltner is based on a moving average exponential I use. It starts getting dragged down with prices and the stops move. So I had some indicators moving down the stops fast, but still they're not keeping up with the velocity that was prices were crashing. The indicators couldn't possibly keep up. So the risk and the volatility kept screaming upward. So let's say if you start with a position of 10 contracts short, you're making a lot of money, but the volatility is exponentially getting bigger and the risk is now getting bigger because you can't move the stops down fast enough. So you run the calculation every day and it says, no, you really should have only 8 contracts now. So I peel 2 off. Then the next day, the same thing happens. It says you probably should only have 7 now. Peel another one off. By the end of the run down, you might be down to 5 or something. And so you got half the position that you had initially, but you got a market that's 2, 3 times as volatile, and the risk is yet to catch up. And then when the market starts actually rallying, now the risk is plummeting because the stops are still coming down. The market prices are coming up to meet the stop price. So the risk is low, but the volatility is high. So it's peeling off contracts still, potentially. Eventually, you get the buy signal, you put on a small position because the volatility is too high, but you start enjoying the ride upward in the opposite direction. So that's kind of the mentality. And if you really build all that into your strategies in the first place and you understand why it does what it does, then you start realizing I don't need to worry about the tail risk or the risk of something crazy happening. I've kind of already built structure in there to make those decisions. Like for instance, a good example, We had, and I think I've said this in other interviews, we were working one night at TrendStat. We had a program, we couldn't get our orders out that afternoon. So I was staying with one of the computer guys and we were under pressure to get our orders in. And we couldn't find the bug. And so I got to be about 5 o'clock. We were exhausted. And said, I'm going to go over and get some Chinese food. And you want something? And we got that. We took a break, had dinner. We got right back to it and immediately found the problem. Just being away, and we couldn't see it initially, but once we got back into it, we found it right away. We fixed it. Orders went in, and at 8 o'clock at night, I was about to go out the door home, and I thought I'd check the quotes and see what was going on. And our oil position, which was long, was up $8 a barrel from 32 to 40. And I'm thinking, what the heck happened? And come to find out that we had invaded from Kuwait to protect Kuwait. It was the first Iraq war. This was back during H.W. Bush's presidency, and it was going well. But war was breaking out in the Middle East, so oil prices spiked. I thought, wow, this is going to be interesting because $8 a barrel of oil on our long positions is going to be a pretty big profit for tomorrow. I wake up in the morning and I walk in and I said, "Trader, how are things going this morning?" He says, "It's rough. Oil's at $22 a barrel. The war is over, and it went from $40 all the way down to 22. We get stopped out, and the risk and volatility on the trade's so great that unless you had about a $20 million account, we couldn't even short one contract of oil." So it ended up being a situation where it's a once in a blue moon type of thing. I think we lost, I forget, it was like 6% that day or something. It was a very big losing day for TrendStat, but we were at new highs in a couple months. But if you build that into the strategies, then you know what you have to do. It sort of adjusts itself. It's not perfect, but you're taking the stab in the right direction. And I think that you have a plan in place and you execute the plan.
That's where being systematic helps. One of the questions which I had was in terms of today, when you look at the instruments that form a part of your trend following system, do you have indexes, the broader indexes like S&P 500 or Nasdaq, or
Mhm.
or it doesn't include that? So my question was
I
around indexes.
Yeah, to get my equity exposure anymore because of both the tax laws in the United States with mark-to-market futures and straddles in the IRS code, combined together with the lack of wash sale rules for securities, it's a lot easier for me to trade futures to get my stock exposure than to trade actual stocks. So I do. I could get back into stocks in a second, but it would require for me in today's world to look at a 50 stock portfolio probably, and I'd have to apply some automation to the problem on the screening side. And so I may do that down the road if I'm really bored, but it doesn't make a lot of sense. It's so much easier for me to trade futures to get my stock exposure.
Got it. And as far as indexes are concerned, have you again observed any changes in terms of their structure? I know you pointed out to the speed of change. Um, I mean, in 70s and 80s versus where it is today. But then, is there anything else that you would want to add in terms of how indexes have changed?
They seem to be dominated by kind of like a few stocks. The
Tech.
S&P is capitalization weighted, and the Magnificent Seven and all that. They get bigger and bigger and become trillion-dollar giants, and they dominate some of the indexes. So you're not getting the effect of one stock necessarily, but you're getting, because of the high correlations, you get into the Nasdaq, you're getting pretty much a tech stock index. But any one company, you could have like a Tesla be down 5% in a day and NVIDIA up 10, and they offset each other to some extent. So there's still a little bit of extra protection there. So you don't have to go out and buy 50 different stocks individually and through all the hassle of doing that, the commissions of doing that, everything, tracking it. It's easier for me to get the exposure through an index futures.
Hmm. let me extend that conversation to this whole idea of active versus passive, which a lot of people talk about, and academia
Hmm.
also says, there's little that one can do being active, and hence it's better to be passive. And folks like, it could be, people like you or me, I'm an active, investor or trader. We obviously are active for a reason. So how do you kind of think about passive investing, uh, and all that, uh, story about you can't beat the index in the long run, all of that? How do you look at that?
I look at it as coming from a bunch of people who don't know how to trade. So
Hmm.
I take it with a grain of salt. I think they don't understand the psychological pressures like I do of not only the trader's own self and the frustration, the anger, the concern, worry, greediness, all those different emotions that you can go through as a trader. That gets down to the client level. So if I'm managing as I was back in this, 80s and 90s, early 2000s, a bunch of client money. I've got the clients putting the pressure because they're going all over the map emotionally. They're calling me up trying to put psychological pressure on me. So I've got to be even better because I've got to not only deal with my own biases and emotions, but I've got to deal with the clients trying to exert
Yes,
even more
yes,
pressure on situation. And so the academics who don't understand trading just simply say, well, the easy way to do this is just ignore it. Yeah, but the clients won't ignore it. So you buy and hold, and the returns over the long run are just fine. But how about that drawdown over there in 1973, 74? How many of those clients stick around for the 50% down move and then enjoy the move that comes after to new highs? Not many. And so it doesn't take the academic studies don't take into account the psychology of the situation and the reality that I see happens out in the marketplace with clients and with traders. When you start factoring that in, if I'm timing a mutual fund, let's say, uh, and I've got my beta against the stock market of essentially a stock market portfolio, but I'm timing it, I can get the beta down to like point 0.5, and that is so much less risk than taking on the buy and hold strategy. And if I can get the returns anywhere close to buy and hold, I would submit to you it's a strategy that a client can live with a lot better than they can the buy and hold.
Hmm, hmm. But then there's also this, trillions of money which is going into passive. Is that
Hmm.
also the reason why, dips get bought into? And
Hmm.
it's essentially, other than COVID, we've largely had an upward drift. So how do you see that? Which I don't think that existed maybe in
Right.
70s or 80s.
Right. And I'm not moving hundreds of billions of dollars for myself in retirement. So, yeah, if you're moving billions, you have to start like if you're the California pension plan or something, you've got billions that you have to figure out what to do with. You're going to be a lot more passive because you can't move that much money into any one position very easily. It takes sometimes days, weeks, and multiple managers. It's difficult. So there you start getting more of the academics saying, just do the passive thing. And in many cases, the academics are backing up the government decision makers that would require that the stuff be passive and justifying it to protect their own jobs. If we do have a down move, we could say, "Well, we were passive. That's what we're supposed to do. Don't fire me for losing 20% of the pension plan." But really, in reality, it's kind of hard to do too much because you end up just have so much money you can't. You'd move the market if you jumped in and out. But that's one of the advantages the small investor has, and I would include myself in that group, small investor, because I can go Like when I was a CTA, I could look at the orange juice market. It trades maybe 200, 300 contracts a day. I would not even contemplate being in the orange juice market when I've got 600 million I'm trying to manage. But I can go in and out with, a few contracts here and there. It's no big deal. The market doesn't care. So I have an advantage over the big guys because I can dance in and out anytime I want, and the cost of moving the market is very minimal.
Hmm. But since we are talking about institutional versus retail trading and the advantages each has, I'm not sure if there was this thing which happened a few months back in India, where this firm, American firm, Jane Street, they were accused of market manipulation here in India. Did you hear about that?
I didn't.
Okay, so the story is a bit like this. So we have an index called Bank Nifty in India,
Yeah,
and it's a weird index because it's got very few stocks. So it's got, let's say, 11 or 12 stocks. So because it's an institution, they they could move the index, and that's what the regulator claims. And then the float is less in those stocks and all of that, and they could move the index. And then on the other side, they could make money through options. What occurred to me when you were telling me, yeah, retail as us as retail, we have some advantages, but then institutions also maybe have some advantages. I don't know. So so
they do.
so that's yeah, that's what running on my mind.
Yeah, the institutional advantages would be extreme diversification. They can play in a lot of games at the same time. They have the computer capability. They have the speed of execution. In many cases, they're vertically integrated so they can actually do the execution themselves. The smaller traders, on the other hand, have the ability to move quickly, exploit a significant amount of the market for their own size, and the transaction costs that used to be very large for the small trader have come down to almost nothing. In some cases in the U.S., you can trade stocks for zero commissions, and futures contracts are just very, very low cost. I used to pay $100 round turns in futures, and now it's down in single digits. It's ridiculously cheap. Everything's electronic, and you don't have to worry about out trades as much and all the different things you had to do in the old days. So, uh, there's advantages to wherever you are, but I think what you have to do as a trader, it would make sense to me, is to analyze your own situation. You don't want to trade like Tom Basso. You want to trade like who you are. How many how many minutes a day are you going to spend on trading? Are you going to be glued to the screen, or are you going to just run some orders at the end of the day and update your stops? What markets are you going to participate in? Are you going to trade futures? Are you going to trade stocks? Are you going to trade bonds? Are you going to trade options? Got to narrow it down. You can't do everything all the time. You're a human being, you got limitations. So you have to be focused. It's almost like developing a business plan for your trading and assessing, here's the size of dollars, the capitalization that I've got. Here's where my skills are. Here's what I understand. Here's what I don't understand. Uh, Here's the resources I have in terms of friends or maybe relatives that would like to do this with me, and maybe we have a joint project to get this done. Uh, where are we going with it? And set up a plan to get to where you want to be.
Got it.
It's not just, oh, let's turn on the screen and, oh, cocoa looks good today. Let's go buy cocoa. That's not a plan. That's just making it up on the fly.
Got it.
You're going to end up just along the way very frustrated.
Hmm. So talking about, I'm kind of shifting gears to something that you've been doing for decades, but then now with technology and, AI, it's becoming easier. So just the way we were talking about, before we got started. So
Yeah.
in India, at least, a lot of retail traders are automating their own trades today. So
Hmm.
there are the APIs of different brokers are easily accessible. And of course, the numbers in terms of order flow would be a small percentage, but then it's a growing cohort of people who want to automate their own trades. And how do you look at it? And what has been your experience in terms of automation?
My experience is that AI is changing the way you code. some fairly complex things. The example we were talking about before we came on, where if I'm sitting here working at my main screen, writing something for a Substack piece or answering emails or responding to people on X.com, I end up focusing most of my energy on the screen that's right in front of me that I'm talking to you on. Over here to my left is another screen. It's got my trader platform. And if I'm going to be sitting here and I know I'm going to be sitting here for 2, 3 hours, then I'll go ahead and bring up my day trading strategy. Well, the day trading strategy is really simple, but it requires my attention once every 5 minutes. So I thought to myself, I'm going to, as an experiment, just use, uh, in that case, it was Grok at the time, and ask Grok, could you do a Python based program that just reads my clock on the computer? Every 5 minutes is when the new bar is going to show up over here on my left screen. Give me a 15-second head start on that and make an alarm go off. And so I'm sitting here, writing something, answering an email, and all of a sudden, ding, ding, ding. And so I look over and I can move my stop if I want, and I go right back to what I was doing. And it really slick. It took me about 3.5 hours to have the AI go back and forth, and I'd say, "Yeah, that's pretty good, but could we do this instead or change the sound? I want it a little bit more noticeable. It's a little too quiet." And we played with it a little bit, tried different things, tried different durations of the beeps, and got it just exactly the way I want it. Now it's an icon on my desktop. I just hit trade timer, and this thing goes in the background and automatic, and then when I get out of it, it stops. I could program in Python real minimal stuff. I programmed all my life from university, but I have to say to try to create what I created with AI would have taken me probably days, and I did it in a couple hours. So it speeds up tremendously what you're doing. You just have to get better at describing to AI exactly what you want, because AI will assume things if you don't tell it, like
It
if
will
you
assume yes.
well, if you say something like, how about generic? I'll give you a stupid example. You say Grok or Claude AI or any of these AIs, you say, okay, AI, uh, tell me the best way to produce the biggest return possible of trading the S&P 500 futures index over the last 2 years. It will analyze the data and it will come up with an answer for you. And the answer will be an over optimization of the last 2 years, and it'll probably be garbage. So you have to be cognizant of how specific you get. You want to allow the flexibility for AI to really solve your problem, but you don't want to just have AI go through the world of everything out there and expect to get anything other than an over optimization of history, of its knowledge base. And so you have to use your brain a little bit with AI. I think a lot of people are going to misuse it, and they'll learn.
Yeah, that's a part of the game. So, but specifically about automation in the context of trading. To what extent is your trading automated, especially the execution bit, not the analysis, but the execution bit?
Execution is 100% automated.
You just
In that,
switch it on.
in well, yeah, I just have to bring it up and hit a couple buttons, and off it goes. So it automates the pull down of the data. So it pulls down prices first and gets them into storage, and then secondarily, then I hit other buttons and it executes the runs, and I hit other buttons and I
Hmm.
transmit.
So for retail traders who want to automate your, I'm assuming you would suggest it's a better way to trade than do it manually.
I would say for most people, probably yes, but there are select people who, I don't know, for example, let's say you came from a currency desk and you did nothing but trade the Japanese yen for 10 years on a currency desk. You're going to be hardwired in your brain to do different things with trading, and it may be more appropriate for you to, I don't know, deal with the range trades, buy and sell and be a little quicker and glued to the screen and use your contacts in the industry to know which way to lean. And I don't know. Uh, Everybody's different. There's not anybody that should be doing exactly one thing, but there are people that can do discretionary trading better than I could. What I did to get to where I am is to analyze who I am. I'm an engineer. I know math. I know computers. I have X amount of dollars that I'm managing. I know futures. I know stocks. I've traded bonds. I've traded some options. I've traded foreign exchange. So I know these are my backgrounds. I know computers. I know math. I have the capabilities. So I put together my strategies based on my situation. So it's custom developed for me. It does not apply to Joe Smith out there in the world with $10,000 and he wants to trade foreign exchange. That's not going to work. You can't
Makes
pick up
sense.
what I'm doing and translate it to him because he's got a
Makes
different
sense.
situation, different
Makes
problem to
sense.
solve. I call it, trading is nothing more than solving your own financial problems. And my financial problems are different than other people's.
Absolutely. Absolutely. So moving on, Tom, I had a couple of questions, and then we'll close the day. So one is, you've been uh, known as someone who is very serene in terms of and keeping your calm in the markets. But then you played two different roles. One, you were managing money at one point of time, and today you manage your own money. Now, when I meet people who manage others' money, you get two kinds of responses. Some people say it's easier to manage others' money. I don't get stressed when it's others' money, but if it's my own money, I get stressed. And then there is another set of people who say, I cannot manage others' money. I'm okay managing my own money. So, how do you look at these two, types of people in the context of uh, being able to deal with the stress or whatever anxiety that comes with trading?
I would back up from both examples and say in life, there are potential stressors. So it could be something like you pull up at a stoplight and the guy in front of you is on his phone or something. The light turns green and he's sitting there holding up traffic because he's not paying attention. That could be a potential stressor. It only becomes stress if you allow it to be stress. But you would have to be aware that it's affecting you that way and just say to yourself, okay, the guy's on his phone. What an idiot. But this music I've got playing on the radio is really cool. And you just relax through it. And same thing is true when somebody calls you as a client and says, how come you lost money this last month? You have to be able to immediately your reaction is, oh, that idiot, he doesn't know what he's asking. The markets were down. Of course we're down. That's stupid. Why are you bothering me? That could be a reaction. It adds potential stress to you, but it's only stress if you take it that way. If you then replace that with a mental framework of, okay, he's a client. He's paying me money to manage his money. He has no idea what trading's all about. That's why he hired me. And I will patiently answer his questions.
That's a
And then it
great way
doesn't
to.
become stress anymore. So there's potential stressors everywhere. And what you said with both examples is exactly true. But I think that you just have to realize you have to be aware of yourself and your reaction to those potential stressors and just be able to change your mental process towards those potential stressors and they no longer become stress.
So, Tom, can we say that your key message is know thyself? So, know yourself better, and the answers are all there.
Yeah, that would be a pretty good summary. Stay in the now. Don't predict. Just stay in the now and understand yourself.
So a couple of more things. You've been watching markets for close to 50 years, and you've seen these cycles and everything. What keeps you going even today? Now you're still trading as we speak.
Mm,
So
yes,
what is it?
it is the brain tease of finding the next trading strategy, the next market to trade. It's fun to be creative. I think the actions of human beings fall into two major categories. One is I do it every day routinely. I brush my teeth, I eat breakfast, I eat lunch, I work out on Tuesdays and Thursdays and Saturdays or whatever. There's certain routines you get into, and those are very repetitive. In many cases, when it comes to trading, the actual updating of your orders, the sending of your orders, the transmitting of that becomes very routine. So that's something that a computer can do. What a computer cannot do, and you'll fail if you ask AI to do it for you, I believe, is to be creative and actually examine markets and think, I should maybe create an option program for the agricultural contracts that could go into a drought or a heat situation or a pest situation where corn goes from $2 to $4 or $4 to $8, and the option would really, really knock it out of the park. I should examine that. That'd be a good idea. So now that's a human being coming up with a creative idea that becomes the kernel of maybe a future program, research project, whatever, and you might end up with another strategy in your portfolio. That's the
Thanks.
fun stuff.
So, but then we also social beings, Tom.
Mhm.
So, are there people who you speak with about these trading ideas, and you know, how does that work?
I usually get interviewed, and I talk to millions of people,
Like
or at
me.
least tens of thousands, through various podcasts and interviews and X posts and Substack articles that I write every now and again. Yeah, that's how I keep in touch with a lot of people. One of the reasons I called it enjoytheride.world instead of .com is not only was .com taken at the time, but .world applies to my followers. They're all around the world.
They
So,
are indeed, indeed.
yeah.
So, you spoke about options. So it kind of occurred to me. Have you traded options? And you said you did a bit. What's your view on options as a product, given your trading style?
It can be very profitable for somebody who wants to be more manually involved. I don't think options lend themselves to the way I like to trade, which is more automated. Uh, Although I guess with robotics, you probably could create a bot that would probably be able to deal with some of that. I just haven't. There's not a lot of interest on my part of doing that because I think it's a lot more involved to try to get like a bot working with respect to options and get everything to flow perfectly. It'd be quite the challenge. So I've traded options, mostly selling premium and collecting it, time decay stuff. Easy once a week decision making. You can do it manually. Doesn't lend itself to automation very much.
Okay, okay, got it. So yeah, I think thank you, Tom. That brings us to the end of this longish, maybe an hour-long conversation. And I mean, one of the biggest things which I take away from this conversation, as you were speaking, was to maintain calm and to reflect on what I'm thinking at any given point of time and act based on that reflection. So thank you, and wish you many more years of active trading, just the way you're doing. And if it comes to if you come to India at some point, we would love to host you. And if I
Yeah,
show up in that part of the world, I would love to see you.
you're very welcome.
All right. Thank you, and let's enjoy the ride.
Perfect.